Top 10 investment strategies for 2024. As we navigate the dynamic financial landscape of 2024, investors are seeking strategies that balance potential returns with risk management. The evolving economic environment, influenced by technological advancements, global events, and shifting market trends, requires a well-thought-out approach to investing. Which investment is best for the next 5 years? Here are the top 10 investment strategies for 2024 designed to help you make informed decisions and optimize your investment outcomes in the coming year. Number 10. High-yield savings accounts. You can earn interest on your cash balance in an online savings account with a high yield. High-yield online savings accounts are accessible vehicles for your money, much like a savings account at your physical bank. For whom are they useful? If you need access to cash in the near future, a savings account is a good option. A high-yield savings account is also a good option for investors who are risk-averse and want to minimize the possibility that they won't receive their money back. Number 9. Long-term certificates of deposit. Banks issue certificates of deposit or CDs, which typically have higher interest rates than savings accounts. Additionally, long-term CDs, which let you keep your money earning higher rates for years, might be a better choice if you anticipate a decline in interest rates. For whom are they useful? For retirees who can lock away their money for a while and don't require immediate income, certificates of deposit, CDs, can be a wise option due to their safety and higher payouts. Risk-averse investors can benefit from a certificate of deposit, CD, particularly if they can tie up their cash in exchange for a slightly higher yield than they would on a savings account and need the money at a specific time. Number 8. Long-term corporate bond funds. Sometimes companies will raise capital by issuing bonds to investors. These bonds can then be bundled into bond funds, which may hold bonds from hundreds of different companies. Since long-term bonds typically have maturities of 10 years or more, they are a better option when interest rates are expected to decline in 2024. For whom are they useful? For investors who want to lower the overall risk of their portfolio while still earning a return, or who are retirees seeking cash flow, corporate bond funds can be a great option. Investors who are risk-averse and seek a higher yield than government bond funds may find that long-term corporate bond funds are a good option. Number 7. Dividend stock funds. Investment vehicles called dividend stock funds concentrate on stocks of businesses that are recognized for their consistent dividend payments. These funds are especially appealing to retirees and income-focused investors because they are made to give investors a consistent stream of income. Typically, dividend stock funds make investments across a wide range of industries, guaranteeing a steady income stream even in the event that certain industries underperform. Frequently, these funds comprise sizable, well-established businesses with a track record of financial success and solid balance sheets. Furthermore, since reinvested dividends have the ability to compound over time and raise the value of the investment, dividend stock funds may present an opportunity for capital appreciation. Depending on their risk tolerance and financial objectives, investors can select from a variety of dividend funds, such as those that concentrate on international dividend-paying stocks, high-yield dividends, or dividend growth. All things considered, these funds offer a well-rounded approach to investing by fusing the advantages of consistent income with the possibility of long-term growth. Number 6. Value stock funds. Investment vehicles known as value stock funds concentrate on stocks that fundamental analysis deems to be cheap. These funds look for businesses whose stock values are below their intrinsic value, usually as a result of short-term setbacks, economic downturns, or market overreactions. Investing in these cheap companies is the aim, with the hope that their stock prices will rise to reflect their actual worth over time and provide opportunities for capital appreciation. Strong fundamentals such as steady earnings, strong cash flow, and low price-to-earnings (P/E) ratios are frequently found in value stock funds. These businesses might also pay dividends, which would add another source of income. Value investing is by its very nature contrarian, since it entails purchasing stocks that the market has discounted. This strategy necessitates perseverance and a long-term outlook, because it might take some time for the market to realize these stocks' actual worth. Nonetheless, value stocks have historically outperformed growth stocks over extended periods of time, so the rewards could be substantial. Value stock fund investors gain from professional management, diversification, and the possibility of lower risk by making investments in reputable businesses. Number 5. Small cap stock funds. Small cap stocks, or the stocks of relatively small companies, are what these funds invest in. Potential gains can be substantial because small caps frequently have strong growth prospects and because many of the largest companies in the market were once small caps. A small cap fund combines several small companies, sometimes even hundreds, into a single easily tradable unit. For whom are they useful? Investors who can endure volatility and are seeking for appealing long-term returns should consider small-cap funds. They should invest for a minimum of 3 to 5 years. Compared to other investment types, these funds will fluctuate significantly more because they are made up of stocks. Number 4. REIT Index Funds. One of the most alluring ways to invest in real estate is through a real estate investment trust, or REIT. In return for not being subject to corporate taxes, REITs distribute dividends which are then distributed to investors through REIT index funds. Buying into numerous subsectors, office, apartments, lodging, and many more, with a single fund is possible with publicly traded REIT funds, which often contain dozens of stocks. They provide investors with a diversified real estate exposure without having to worry about the hassles of property management. It might be time for REITs to shine in 2024 after a few challenging years due to rising rates. For whom are they useful? REIT index funds have high dividend payouts, which makes them a desirable location for investors who prioritize income, like retirees. However, REITs also have a propensity to expand over time, offering some chance for capital growth. Due to the significant price fluctuations of publicly traded REITs, investors must have a long-term perspective and be prepared to tolerate volatility. Number 3. S&P 500 Index Funds. Based on approximately 500 of the biggest American companies, an S&P 500 index fund includes many of the world's most prosperous businesses. Amazon and Berkshire Hathaway, for instance, are two of the index's most well-known members. For whom are they useful? An S&P 500 index fund is a good substitute if you want to attain higher returns than more conventional banking products or bonds, despite the fact that it is more volatile. For novice investors, an S&P 500 index fund is a great option because it offers wide-ranging, diverse exposure to the stock market. For any stock investor who can stick with their investment and wants a diversified portfolio, an S&P 500 index fund is a good option for at least 3 to 5 years. Number 2. NASDAQ 100 Index Funds. For investors who want exposure to some of the largest and most promising tech companies without having to pick winners and losers or conduct in-depth analysis of individual companies, an index fund based on the NASDAQ 100 is a great option. The fund is based on the 100 biggest companies on the NASDAQ, which are some of the most prosperous and reliable businesses. These businesses make up a sizable chunk of the entire index, including Apple and Alphabet. Another well-known member company is Microsoft. For whom are they useful? An excellent option for stock investors seeking growth and able to withstand substantial volatility is a NASDAQ 100 index fund. The ability to commit to holding it for 3 to 5 years should be required of investors' years. Using dollar cost averaging to buy into an index fund can help reduce your risk compared to buying in with a lump sum. Number 1. Rental housing. Residential properties that are leased out by owners to tenants in exchange for regular rental payments are referred to as rental housing. A range of property types, including apartments, single-family homes, condos, and townhouses, are included in this category of housing. Because it offers people who might not want or be able to buy a home flexible living options, rental housing plays a crucial role in the housing market. Young professionals, students, and people who move around a lot for work or personal reasons are the main demographics that find it appealing. A set of laws that specify the obligations and rights of landlords and tenants regulates the rental market. Typical lease agreements outline the length of the rental period, the rent amount, and additional details like upkeep obligations and usage guidelines. Landlords are in charge of making sure the building is habitable, taking care of repairs, and following neighborhood housing laws. Conversely, tenants are expected to maintain the property, pay rent on schedule, and abide by the terms of the lease. Markets for rental housing differ greatly depending on factors like demography, location, and economic status. Because employment, amenities, and transit options are concentrated in urban areas, demand and rental prices are frequently higher there. In contrast, the cost of renting in suburban and rural areas may be lower, but come with trade-offs, such as longer commutes or fewer amenities. The information provided is for general informational purposes only and should not be construed as investment advice. Past performance is not indicative of future results, and all investments involve risks, including the potential loss of principal. It is crucial to conduct your own research, consider your financial situation, and consult a qualified financial advisor before making any investment decisions. So if you like our video and you want more similar topics to see in future, then subscribe to our channel.